Well, hello and welcome back to Principles of Accounting 2. I am still your host, Dr. B. We made it through the first week of the course, so congratulations on that. That first week is always interesting, especially in a new course, right? So just to quickly recap what happened last week and where we are today. So if we go into the classroom, under week one, which was last week, a couple of things that we went through. Of course, we went through the introductions and all that great stuff. We also talked about chapter 17, which was analyzing financial statements. And we also talked about QuickBooks in a very logical way. So, what did you have to do for last week? You had a QuickBooks Online Essential Training through LinkedIn Learning, where you downloaded a PDF certificate and uploaded that to the Dropbox here under Expression and Action. You also had a Chapter 17 discussion board and a Chapter 17 quiz. So, yeah, last week was a very busy week. You had four things going on at the same time, really. Three things that you had to submit. And so I just wanted to say thank you for your hard efforts in the class so far and getting those three things done. So why is it important to stay on top of the things in this course? As you have probably already noticed, every single week is full of stuff. There's a lot of things to do. So here we are in the second week. So today we're going to talk about managerial accounting, and we'll also cover a concept called job costing. Alongside this week, there are a couple things going on. So we have the instructional materials for this first one here is for managerial accounting, and the second one is for job costing. So that's where you'll find the PowerPoint presentations and a couple of related videos to help you. And then under Engage and Explore, you'll have a hypothesis video for this chapter that we're about to talk about, which is managerial accounting. And you'll have a discussion board for job costing. And then the other two things you'll need to do for this week is a quiz on managerial accounting, chapter 18. And chapter 19, you'll have another quiz, and that'll be for job costing. So those are the four action items you have for this week, which will be due this Sunday night. Now, of course, since we hold lectures on Tuesdays, I would strongly encourage you to use the class time on Thursdays to complete those four things. That would be my best recommendation for you for success in this week. So, okay, so that's where we were, that's where we are. So let's jump into our presentation on managerial accounting. So please stand by as I'm going to adjust my display, and here we are. So let's jump into our discussion. And as always, if you have any comments, questions along the way, feel free to unmute your mic and ask your question, or you're more than welcome to also type it into the chat. So, managerial accounting, what is it? Why do we study it? It is everything that we're going to cover in Principles of Accounting 2. Managerial accounting focuses on management's responsibility to effectively manage the company using financial information to make decisions. That's the long way of saying what is managerial accounting. Managerial accounting provides accounting information that's financial and non-financial to decision makers, to make decisions. That's why we call it managerial accounting. That is what we focus in Principles of Accounting 2. Back in Principles of Accounting 1, we talked about financial accounting. And then we're going to talk about the differences between the two. Management's primary responsibility in the business is, of course, to manage the company. And management does that using financial and non-financial information. to make decisions. We go through what's called a management cycle. The management cycle involves two primary factors. We call it planning and control. Okay, planning and control. Management plans for the future of the business. They plan for the direction of the business through what we call strategic planning. We develop a strategic plan based off of our mission statement and our vision statement to guide the company forward. We identify what our goals are, both short term and long term, and what we need to do to attain those goals. That's planning. Okay. Plans can include things like building a new factory, developing new products, expanding into new markets, etc. We plan to do those things. How do we do that? We build what's called a strategy. The strategy helps us to drive the plan forward. When we execute our plan through our strategy, we need to evaluate our performance. Okay? And the way we do that is through a process we call control. Okay? We control our actions based off of our plan and executing it through the strategy. We control the process. We control the procedures. We control our costs. Okay? We control our costs. We control our profitability. We control our customer satisfaction. These are the things that we look at to benchmark our performance against our plan. And of course, we evaluate the performance to help us to plan again. This is part of the management cycle. Okay. The way I want you to think about it in this course is planning are things like budgeting. We create budgets to help us to sell products, to help us to understand the cost of manufacturing a product and the cost of bringing that product to market. Okay? So budgeting is a huge part of planning. On the control side, we benchmark or compare our actual performance to our budget. Okay, so that's how I want you to think about this. And the reason why I want you to think about it that way is because throughout this entire course, we will be looking at costs at a very detailed level. And we're going to do that through the lens of a manufacturing company. The reason why we look at a manufacturing company to understand cost is because there's a lot of costs involved in the manufacturing process. When we create a product, we look at three primary costs associated with making that product. We have direct materials, which are the materials used to make the product, direct labor, which are the employees making the product, and the third cost we look at closely is called manufacturing overhead, which are all of the related costs to the manufacturing process. Those three costs together equal the total cost of a product. And we're going to look at those very closely throughout this course. So I want you to think about planning, which is budgeting, and control, which is comparing the budget to the actual performance. So earlier I had mentioned that this course focuses on managerial accounting. You'll notice that in your last course that you had with me or with another accounting professor, Principles of Accounting 1, we focused on financial accounting. Financial accounting, you learned how to develop the income statement, the balance sheet, the statement of cash flows, the statement of retained earnings. You learn how to develop those things in order to present them to users like creditors, investors, the government, people outside the company. You know? And the reason why you did that is to generate some income for the company based off of investment or for banks to make credit decisions, etc. When you developed the income statement, balance sheet, statement of cash flow, statement of retained earnings, you followed generally accepted accounting principles. And I'm sure you remember the basic principles like the matching principle, the revenue recognition principle, the expense principle, etc. Right? You remember those basic principles because we used them in the development of the financial statements, income statement, balance sheet, statement of cash flow, statement of retained earnings. That was financial accounting. That was Principles of Accounting 1. In this course, Principles of Accounting 2, we focus on managerial accounting. We look at other kinds of reports, like the cost of goods sold report, the cost of manufacturing report. We look at other internal reports, like the budget, managerial reports. Okay. The type of reporting that we'll talk about in this course are used for internal purposes. Management uses these internal reports to make decisions, right? That's why we call it managerial accounting. In managerial accounting, we don't necessarily follow generally accepted accounting principles. Why? Because these types of reports I just mentioned, like the cost of manufacturing report, that doesn't get published. We don't tell the world about our costs. Okay? Why? Because they're not the type of information we don't want made public. So that's why we don't have to follow generally accepted accounting principles when we develop a budget or when we establish those types of reports that are used for management. They're internal. Yeah. They help to guide the company. So that's the primary difference between what you learned in Principles of Accounting 1 and what we're going to be learning about here in Principles of Accounting 2. So Principles 2 focuses on managerial accounting. You may recall briefly that we talked a little bit about ethics in Principles of Accounting 1. We touched briefly on this. And it was probably toward the beginning of the course. The reason why ethics is so critical in accounting is because we're dealing with money and people. We need to uphold very high ethical standards. And so there are associations that have helped to develop methods to help to control and prevent fraud from happening. Yeah? We call this the fraud triangle. This fraud triangle was established to help to prevent fraud from happening. There are really 4 procedures, if you will, processes, that management uses to help to prevent fraud. Number 1 is we ensure reliable accounting. It's true, accurate, transparent. Number 2 is we protect the assets, whether that's physical security using a lock and key or security cameras or security personnel. We also have policies and procedures in place to protect our employees and to protect other physical assets that the company owns. Number 3 is to uphold company policies. If we follow policy and procedure that the company has established, we'll be able to prevent fraud. And the fourth, of course, is to promote efficient operations. If we eliminate redundancies or overlap and we eliminate waste, we make the business more efficient and therefore help to prevent fraud from happening. You'll notice the fraud triangle on the right hand side, that little image: opportunity, realization, and financial pressure. These are the three elements of why fraud happens. There's an opportunity to commit it. Oh, the owner's back is turned to the register. Who's to say I wouldn't open that register? Opportunity. Rationalization. Well, my bills are coming due and this company's not paying me enough, so maybe I should just, it would be okay if I take money from the company. That's rationalizing it. The financial pressure. Well, all those bills and all this responsibility I have, uh, you know, maybe I should do something about that. Those are the three components of why fraud happens. In managerial accounting, there are a lot of jobs, a lot of different positions that accountants have. You can see here top level managers, the CFO, the controller, mid level, division controller, general manager. Mid to entry level, we have financial analysts, senior accountants, staff accountants, etc. All of these individuals are involved in financial and managerial accounting. Okay. There are a lot of career paths in accounting that are not just accounting related. We deal with financial and non-financial information to help make decisions, right? That's what accounting does. That's what it's for. Okay. Uh, there's a lot of different positions and organizations that accountants are involved in. Yeah. So it's something to think about, as you progress through your career. You might say, oh, Dr. B, accounting's not really for me. It's not something I'm interested in. It's not something I want to do with my career. That's okay. But I want you to know that there are a lot of different layers to accounting, you ranging from all the way from entry level all the way to top level management. Uh, and these individual roles, they deal with a lot of different things. You see a general manager on there, for example. Uh, for those of you who might be hospitality majors, you understand that the general manager of the hotel, they have a very strong influence on accounting, right? They lead the business. They have to know the numbers, and so just things to think about. So, as I had mentioned, in this course, we're going to focus a lot on cost. And I want you to get into the mindset of a manufacturing company. And the reason why I want you to think about manufacturing is it helps us to better understand cost and the different types of cost. So, here we have an example of a manufacturer that produces bicycles. Okay. In manufacturing and other areas of business, we have what's called direct costs and indirect costs. These are two different categories of cost. Direct costs are costs that we can trace directly to the product. Okay? Direct costs are costs we can directly trace to the product. Two of the biggest direct costs are direct materials and direct labor. Okay? I can track the raw materials that are used in the manufacturing of a product. In our bicycle manufacturing example, the direct materials would include things like rubber for the tires, the steel frame of the bike, the cables for the brakes, the chain, etc. Yep. These are what we call direct materials. They make up the majority of the cost of the product, and I can trace those costs of those direct materials directly to the product. You see? That's why I call them direct costs. Other direct costs would include direct labor. Direct labor are the costs of the employees that are directly involved in the manufacturing process. These are the people on the assembly line. They're the ones responsible for making the product. Okay? That's what we call direct labor. So those are direct costs. We also have what we call indirect costs. These are costs that cannot easily be traced to the manufacturing process, although we know that they are related to the manufacturing process. So therefore, we call them indirect costs. I cannot easily trace indirect costs to the manufacturing of a product. The reason for that is because some costs cover the entire company or the entire factory. So it's hard to trace those kind of costs directly to one product. You see? So indirect costs would include things like rent, depreciation expense, insurance, utilities, the manager's or supervisor's salary, the accounting department, administration, sales department, etc. The reason why a manager's salary would be considered an indirect cost instead of a direct cost is because the supervisor or manager is not directly touching the product. They are supervising the employees that do that. Okay? Therefore, management and supervisors are considered an indirect cost. Okay? We call that indirect labor. Yep. We also have what's called indirect materials. Indirect materials are materials that make up a very small amount of the cost of the product. This would include things like oil for the chain on the bike. Very small amount of cost. It's hard to trace it. Okay, oil for the chain of the bike, the fabric for the seat. Very small, minute components. They're so insignificant that they're hard to track directly to the cost of the manufacturing. So therefore, we call it indirect cost. Make sense? Are we good so far on direct and indirect costs? This is like the very beginning of a very deep conversation. Good? Okay, awesome. Thank you. Thank you. Thank you. Okay, as I mentioned, direct costs include direct material and direct labor. Direct materials are the raw materials that I can directly trace to the manufacturing of a product. Okay, examples for our bike would include things like tires, seats, the frame, pedals, brakes, cables. I can allocate all of those individual components, those raw materials, and I can trace those to a single bicycle. Yeah, I can do that to all the bicycles I manufacture. Yeah, direct materials. They make up the majority of the cost of the product. Direct materials. Direct labor are the employees on the assembly line. Direct labor are the employees that are responsible for the manufacturing process. They are directly involved in making the product. Okay. The direct labor in this case are the hourly wages of the employees that are working on the manufacturing of those products. Yeah, it's their wages, hourly wages. And we track those wages based off the amount of time that they spend working on that product. Yeah. The third largest cost in manufacturing a product is called factory overhead. We have direct materials, direct labor, and factory overhead. Factory overhead are all of the other costs that are related to the manufacturing process that we cannot directly trace the manufacturing of a product. As I had mentioned earlier, this would include things like rent, depreciation expense, utilities, the manager's salary, which is indirect labor, indirect materials like nuts and bolts and very small components like oil, etc. And then any other indirect cost, like maintenance expense on the machines. We classify those things in factory overhead because, again, you cannot directly trace them to the manufacturing product, although they are related to the process. Okay, so those are the big three. And we're going to talk about those big three costs: direct materials, direct labor, factory overhead, every single day in this course. Okay, that's what we focus on in managerial accounting. It makes up the majority of it. We can further classify direct materials, direct labor, and factory overhead into two categories. We have what's called prime costs and conversion costs. Prime costs are the costs directly related to the process. They're prime. They make up the majority of the cost of the product. Prime. That's what prime means, majority. Okay. Direct materials and part of direct labor are prime costs. They make up the majority of the cost of a product. And then we have what's called conversion costs. Some direct labor and all factory overhead are what we call conversion costs. We convert those costs from factory overhead and direct labor, we convert them into an amount that we can apply to the cost of a product. For example, rent expense is a part of factory overhead. I cannot directly apply rent to the cost of a product. I can't trace it, right? It's an indirect cost. It's part of factory overhead. Because rent is an indirect cost and a part of factory overhead, I take the total rent amount and I divide that by the number of units I have produced to find the amount of rent applied to the manufacturing cost. I'm converting the cost of rent by doing that. That's why we call those conversion costs. It's a way of allocating the cost. So that is prime cost and conversion cost. You might hear those terms a few times, so it's important to understand what they are. Okay, as I've mentioned, there are three primary manufacturing costs. Direct materials, those are the materials used in the manufacturing process. Direct labor, the employees directly working on the manufacturing process. And factory overhead, all of the costs that I cannot directly trace but are related to the manufacturing process. Those costs are combined into the total cost of a product. Now, call those product costs. Direct material, direct labor, and factory overhead are product costs. When we manufacture a product, we eventually need to sell it. Yeah, it makes sense. I'm not just going to make things and not sell them. I'm going to make them and then sell them. Right? When I sell them, there's related cost to that. Right? I got to pay my salespeople commission. I got to pay my sales managers. I got to pay for the marketing. I got to pay for the shipping. Those are all what we call selling and administrative expenses. Selling and administrative expenses are what we call period costs. Those costs are accounted for during the period in which they occur. Okay? For example, here we are in the month of October. I've sold 4,000 bicycles in the month of October. For those 4,000 bicycles that I sold in the month of October, I have to pay my salespeople. I got to pay them their commission. I got to pay the salaries. I got to pay for the marketing. I got to pay for the shipping. Those are all selling expenses. Right? I account for those expenses in the month of October because that's when I made the sales. You see, that's why we call them period costs. They're related to the period in which we sold the product. The same with general and administrative expenses. This includes things like the accounting department, the legal department, the purchasing department, etc. All of those administrative functions that support the sales. They support the manufacturing. So they also get accounted for during the period in which they've occurred, for period costs. So that is product cost versus period cost. And here I can show you difference between the two. So product costs, again, direct materials, direct labor, factory overhead. Those are product costs. And then period costs are selling and administrative expenses related to the sales of the products during that month, during that period. See? So this kind of shows you the differences between the two. Especially like for our example, making the bike, direct costs, that's all the direct materials, direct labor, of course. Then indirect costs, factory overhead. The period costs for selling the bicycles would include things like advertising, sales salaries, sales commissions, etc. General administrative would be accounting, employee wages, office rent, office equipment depreciation, all of the supportive stuff, yeah. Selling administrative. How do these costs impact the financial statements, the income statement, the balance sheet, statement of cash flows? How are they affected, you might ask? Well, through the classification of the costs. Here's how it works. Period costs, as you just learned about, are costs that are related to the process, like selling and administrative expenses. You hear the word expense, right? As you know, expenses find their way onto the income statement. Yeah. The income statement is composed of revenue, sales, minus cost of goods sold equals gross profit, minus all your expenses equals net income. Yep. That's your income statement. So period costs are only found on the income statement. What about product costs? Product costs include direct materials, direct labor, and factory overhead. We add those together to get a product cost. When we manufacture products, we're creating what we call inventory. Inventory are the things that are available for sale to be sold, right? There's three kinds of inventory that you need to know about. The first kind of inventory is called raw materials inventory. Raw materials inventory are the inventories that have not yet been processed into making a product. They're raw materials. For example, in our bicycle example, we have aluminum for the frame. That's a raw material. We have leather for the seat, raw material. We have rubber for the tires, raw material. They haven't been processed yet. They haven't gone into what we call work in process. So we consider them raw materials inventory. Inventory is an asset. Assets are found on the balance sheet under current assets, right? The second category of inventory is called work in process inventory. Just as the name implies, work in process inventory is the direct materials plus the direct labor that's currently in the manufacturing process on the assembly line. Okay? It's work in process. We're working on making those bikes. We took it out of raw materials, put it into work in process. That's called work in process inventory. The third type of inventory is called finished goods inventory. Finished goods inventory is when we have completed the manufacturing process. We put the bike together and now it's ready and available for sale. It's sitting on the showroom floor. It's finished. It's a finished good. Okay. So raw materials inventory, work in process inventory, and finished goods inventory. Those are the three types of inventory you'll find on the balance sheet under current assets. Okay. When we sell the finished goods, when a customer comes in, buys the bicycle, when we sell it, it comes out of inventory because we sold it, and it goes onto the income statement as cost of goods sold. Okay, that's what this flow chart is showing you. Think about the physical flow, okay, of inventory. I want you to think about the physical flow of inventory. How does a product start? It starts as raw materials. It goes into work in process to make the product. Then it goes into finished goods. Customer comes in and buys it. It becomes cost of goods sold. See? Follow the physical flow. We can apply the same type of process to service companies. Yeah, absolutely. A dentist, for example. A dentist is a service business. So you might be asking, well, Dr. B, what does a dentist have for raw materials, work in process, and finished goods? They don't, but they have similar costs. They have direct materials, like a dentist would have fillings and other types of things that go into a patient's mouth. Yeah. Direct labor, that would be your dental hygienist and the dentist themselves. Overhead, the dentist office, utilities, rent. Then, of course, selling and general administrative expenses that go along with running the office. So we can apply those same types of costing concepts to service businesses. That's what we're trying to get across here. So let's take a look at the inventories and the income state. We'll look at the balance sheet and income statement for a manufacturing company. So as I had mentioned, three types of inventory: raw materials, work in process, and finished goods. Raw materials are raw materials. We haven't processed them yet. They're waiting. Okay. They're sitting in the yard. They're waiting to be processed. Work in process inventory. This is the partially completed units. I have some direct materials, some direct labor, some factory overhead that we're adding up as we're manufacturing the product. And then when it's done, it goes into what we call finished goods inventory. It's done, it's finished, and it's ready to be sold. So those are the three types of inventory that we discussed earlier. You're going to find those three types of inventory on your balance sheet for a manufacturing company: raw materials inventory, work in process inventory, and finished goods inventory. For a retailer, merchandiser, there's only one type of inventory, and that's called merchandise inventory. And then, of course, for a service company, they don't have inventory. Those are the differences between the three types of companies. What about the income statement? So, as I had mentioned earlier, when we sell a finished good, it comes out of your balance sheet and onto your income statement as what we call cost of goods sold. Okay. How do we find cost of goods sold in the manufacturing business? We take beginning finished goods inventory plus the cost of goods manufactured minus ending finished goods inventory equals cost of goods sold. You heard me use the term called cost of goods manufactured. Cost of goods manufactured represents the direct materials, the direct labor, and the factory overhead that make up the total cost of a product. That's the cost of goods manufactured. So that's for the manufacturing company. For a retailer, and you learned this one last semester or last course, beginning in merchandise inventory plus cost of purchases minus ending inventory equals cost of goods sold. So that's the primary differences between the two types of businesses. A service company doesn't have that because they're not selling products. It's important to think about, especially in this course, since we look at cost primarily, is to think about the physical flow of goods. Okay. This flow chart shows you the physical flow of goods as it goes through the manufacturing process. It all starts by purchasing the raw materials. We purchase our raw materials from our supplier. In our bicycle manufacturing business, we purchase rubber, we purchase aluminum for the frame, we purchase uh, the the gears, we purchase the brake lines, etc. The raw materials. We purchase those raw materials from our suppliers. Okay. We receive the raw materials into the business. We store those raw materials and we account for those raw materials in our raw materials inventory. Then the manufacturing process begins. And the way it works is we take some of those raw materials based off of our needs out of raw materials inventory and we put it into work in process inventory. In the work in process stage, we have our raw materials that we're starting to use, okay, direct materials plus direct labor, the employees that are directly responsible for making the product, plus factory overhead. So indirect costs, right? So we add those up as it moves through the stage of work in process until it becomes what we call a finished good. It comes out of work in process inventory when it's done, and all those costs added together move into what we call finished goods inventory. At this stage, it's ready and available for sale. When we sell the finished good, we take it out of our inventory, out of finished goods inventory, and it moves on to the income statement as costs of goods sold. Okay. On our balance sheet, we have the three types of inventory: raw materials, work in process, and finished goods. It's so important that when you think about costs, to follow the physical flow of the inventory. It'll help you in your mind to understand the costs associated with it. As I had mentioned when we first started our conversation, there's a lot of internal reports in managerial accounting. One of those is called the Schedule of the Cost of Goods Manufactured. And what this report does is it helps to summarize the manufacturing process, right? So here is the formula for the cost of goods manufactured. We start with direct materials used. Direct materials used. We use direct materials in order to make the products. So direct materials used plus direct labor plus factory overhead equals the total cost of manufacturing plus beginning work in process inventory minus ending work in process inventory. So you're looking for the difference. Equals cost of goods manufactured. Okay. This formula will help you to find cost of goods manufactured, especially if you see it on a quiz, for example. Just saying. What does it look like in report format when we put it on our manufacturing statement? Here's the schedule of the cost of goods manufactured. As I mentioned, this is a managerial accounting course. We focus on costs primarily, and we focus on internal financial statements that management uses to make decisions. You'll never find these published They're not public information. Okay, they're only for management purposes. So here we have the schedule of the cost of goods manufactured. We have all of our direct materials laid out. To find direct materials used, plus step 2, we add in direct labor. Step 3, we find all of our factory overhead. We add in total factory overhead to find their total manufacturing costs. And we add in beginning work in process inventory minus the ending work in process inventory equals cost of goods manufactured. So this report, again, helps management to understand exactly how much material was used, how much labor was used, how much overhead was used during the period, during the month. Yeah. So a couple of calculations, of course. Total manufacturing cost, as you know, is direct materials plus direct labor plus factory overhead. We take total manufacturing cost plus ending work in process inventory minus ending work in process inventory equals cost of goods manufactured. Just the same formula again, just displayed in a different way. Here we can see how the cost of goods manufactured statement report is related to the income statement and ultimately to the balance sheet. Work in process, as you know, is a item of inventory. Inventory is a current asset on the balance sheet. Cost of goods manufactured is a part of cost of goods sold. Yeah. So that's where you'll find it on the income statement. Shows you how it's all related. Yeah. So as we go through the course, these are the types of things that are current happenings in Principles of Accounting 2, Managerial Accounting. We look at things like customer orientation, what our customers think about a product, e-commerce, lean practices, the global economy, service economy, value chain, digital manufacturing. All of these things together represent both financial and non-financial information that are used by management to make decisions. These are the types of trends that we're currently looking at in managerial accounting. Lean principles means that we look to limit waste within the company. We try to operate on a lean standard, which simply means that we look for ways to eliminate waste. We look at ways to be more efficient, and of course, ways to better satisfy our customers. Total quality management takes into consideration both quantitative and qualitative factors, financial and non-financial information to help make best decisions in terms of the overall quality enhancements to the product and to the business. In a lot of manufacturing cases, we use what's called just-in-time manufacturing. This is where we receive a customer order and then we manufacture the product. It's based off of the customer's order. You see, rather than making a whole lot of the same product over and over again and hoping that we sell it, instead of that, a lot of companies will receive the customer's order and then they'll manufacture the product. An example that I like to use of this is Toyota. The Toyota car company manufactures cars based off of customer orders and of course dealership orders. But the company receives the orders from the customers and then they schedule the manufacturing of the vehicles. They receive the materials just in time for production. They get the employees together just in time to produce it. And they ship the vehicles to the customers just in time. You see, that's why we call it just in time inventory, manufacturing. It limits the balances of inventory that we carry. Value chain is where we add value throughout every step of the manufacturing process. Corporate social responsibility is where companies behave more socially responsible. They are responsible for things like the natural environment, the people that they serve, overall environmentally and socially responsible. That's the idea. A couple of ratios you should know about when we talk about inventory. One of those is called raw materials inventory turnover. It tells us how efficiently we are using our raw materials, how long it's sitting there for, right? So to find this, we take raw materials used divided by the average raw materials inventory. Again, as I had mentioned before, to find the average of something in accounting, we take the beginning balance plus the ending balance divided by 2. And the last ratio I want you to know about for today, at least for this chapter, is days sales in raw materials inventory. This tells us how long the raw materials have been sitting in inventory for not being used. We take ending raw materials inventory divided by raw materials used times 365 days. This gives us the number of days that the inventory has been sitting. Okay, my friends, that is the end of our discussion on managerial accounting. This is the first chapter that we're covering today. Next, we're going to discuss job order costing. Are there any questions so far on managerial accounting about any of the costs that you've learned over the past hour? Any questions? We okay? We're doing all right so far. Everyone's still awake. Hopefully you're taking great notes. Questions? Or we're okay? Thumbs up if you're good. Okay. All right, great. Let me stop this part of the recording and then we'll start the next one on job order costing. So please stand by.